All right. Hi, everyone, and welcome to NP Capital Advisors' second installment in the Small Business Essentials series. My name is Hannah with Elevate Partners, and I'll have the pleasure today of moderating a conversation with Nick Desai, a founding partner of NP Capital, and Justin Oltz-Green, an operating partner of NP Capital in CPG, automotive, and toys, for a conversation on smart cash flow strategies in a tariff-impacted market. Justin and Nick will first share their thoughts, and then we'll get into some audience Q&A. So please feel free to add your questions to the chat as we go. The whole podcast will be under 30 minutes because we know you're busy, so we want to keep this short and sweet. Before I begin, though, I want to quickly introduce NP Capital and our panelists, Nick and Justin. NP Capital Advisors is a next-generation investment bank and consulting firm founded by a team of experienced entrepreneurs, bankers, and attorneys who have built, operated, and sold successful businesses. The firm offers tailored solutions across M&A, restructuring and turnarounds, and strategy and growth consulting in a variety of sectors. With a performance-driven fee structure and a track record of delivering exceptional results, NP Capital Advisors is dedicated to helping founder-led and emerging growth businesses maximize value and overcome challenges. Nick Desai, founder and CEO of NP Capital, previously built and led multiple CPG companies, including the Pitos brand, after entering the consumer space in 2011 with the acquisition and turnaround of Energy Club LLC. He has raised over $20 million from strategic investors and delivered strong returns, including the sale of Sunkist snack brands in 2018. Today, his founder-first mindset and deep operating experience drive NP Capital's commitment to solving even the toughest challenges for clients. And Justin Oltz-Green, operating partner, is a global executive and investor with over 20 years of experience scaling brands and transforming operations across automotive, consumer products, and manufacturing. He has led growth from early stage to enterprises larger than 400 million, launching iconic brands like Florence by Mills and Pattern Beauty, driving major operational turnarounds, and closing strategic exits above expectations. Specializing in bringing founder vision with scalable infrastructure, he brings deep expertise in supply chain, international expansion, M&A, and turnaround leadership. So without further ado, I'll share my screen and leave Justin to kick things off. Give me a second here while I find the presentation. All right.
Thanks, Hannah. Are you ready to go?
Yeah, ready to go.
Excellent. So, as you mentioned, Hannah, some of the industries we're focusing on, like automotive and toys, a lot of companies are realizing that tariffs are here, and the reality is that they're unavoidable. They're constantly changing, directly hitting cash flow of small and mid-sized businesses. So you can't wish them away. It's really about strategizing and designing around them with supply chain and cash flow and other components of the business. So for those who aren't as familiar with tariffs, they're paid by the importing company the moment that goods clear U.S. customs. So that's not when you sell the products, but way before that typically. So if the majority of your shipments, as is the case with a lot of these market verticals, if they land in preparation for holidays, as a lot of them have, in toy and automotive in particular, you'll have months of cash outlay before revenue really kicks in once you sell the product. So this article really goes into 5 steps you should take as you assess the tariff impact on your goods and then plan how to proceed with the business. And in a climate when inventory costs more, cash flow intelligence becomes even more strategic advantage.
Definitely. And so for the first thing that companies should do when they're dealing with tariffs should be to understand their SKUs, right? Can you get into more about what that looks like and what the some examples of companies that you've seen do that to incredible effect?
Right. And so when we say SKUs, most companies on this podcast are probably familiar. That's a stock keeping unit or just the product or item number. All of those SKUs, every product that somebody sells, have an HS code. That's a harmonized system code that U.S. Customs use to tariff and tax companies, again, once the goods are imported. And so a lot of companies rely on their suppliers or potentially freight forwarders to come up with what that HS classification is, and that can be a costly assumption. And just some examples, toys can generally be classified as HS95, but the subcategory, so inside of toys, you have puzzles, plush toys, electronics. That, the difference between those different types of toys can change the duties by double-digit percentage points. And the same goes for automotive parts. Distinctions like plastic or metal, CNC machines, like the process of making the product, versus molded can materially shift costs. And then about instances that we've worked with other companies in these cases. So Section 301 tariffs, a lot of people started to understand about 7 or 8 years ago once those were implemented. And we came across a company that was importing plush characters, and it played a sound, and that was classified under Chapter 95. But legally, the primary function was electronic. So once we moved it to Chapter 85, the code eliminated the 301 penalty and saved them close to 6 figures a year.
Wow.
And the same's happened in automotive. So a brand selling a universal aluminum turbo kit assumed it was to be classified under 87008 with a 25% tariff on Chinese imports under that code. But because it was engineered to a specific vehicle model, it properly fell under aluminum articles classification instead, which isn't on any 301 list. So that classification saved nearly $1 million a year. So the reclassification ensures that the product is being classified according to what it actually is. And so that's some of the help that we can provide and save companies thousands or potentially millions of dollars just to make that correction.
Yeah, this was really illuminating for me because I was like, you always read about tariffs on the aggregate level, and you're like, oh, okay, so Indonesia is going to get taxed at X% or blah blah blah. But really, it looks like the devil's in the details, and you really got to dig into what particular sector you in, and even further than that, what particular item are you selling and what's that coded under?
Exactly.
Yeah, that's real money.
So typically when companies kind of come to the realization that the initial instinct is like, oh gosh, we got to change our supply chain completely. Like maybe we should move to another country. But I think like when rules change, and they're changing often, companies our suggestion is that they don't make the knee-jerk reaction to immediately change location. The best course of action is often to avoid those hasty decisions, and instead to create a near-term plan to look at your cash flow and buy time. So optimizing your supply chain obviously makes a lot of sense. The USMCA, US, Mexico, and Canada alliance may be a reliable long-term solution for some, but it won't be feasible for a lot of companies. And tariff rules are constantly changing. So that means trying to gamify the supplier's location is often futile. And it's unnecessarily expensive to relocate production just for the sake of tariffs, which can change month to month. We've worked with companies that have shifted production from China to Cambodia, Indonesia, others that have gone to Vietnam to avoid Chinese imports. But then they're now moving production back to China due to tariffs that are being put in place across ASEAN, the entire kind of Southeast Asia region. So it's often good idea to let the tariff dust settle before making any immediate operational decisions.
Yeah, when things happen, I think on this global and massive a scale, at such an aggregate level, I think in general in business is better to kind of just wait and see before you start making, quick moves, because you may find that the problem, either solves itself or at least settles down, right?
Exactly.
One of the things that I think that leads into is the notion that I've have come across just talking to a lot of CEOs and management teams is the notion of a lot of times with these tariffs, there's an initial reaction to say, okay, we need to either switch suppliers or switch locations, switch countries, which means switch suppliers. I think that a lot of folks that we're talking to are finding that the better strategy is to actually work within their existing supplier framework and have the suppliers help come up with the solutions, because obviously this is something that's affecting all parties. And often your supplier is especially with the smaller businesses that we deal with, the suppliers are more sophisticated, larger, better even able to absorb some of these impacts, and may have better long-term solutions that they can help walk you through by going to other parts of the world, or galvanizing other assets in other parts of the world in order to get around some of the tariff concerns or tariff issues. So I think the first step that we advocate is talk to your existing supplier network openly and try to frame the issue that you're having, and see what can be done together to kind of come up with a solution.
Yeah, and I think one of the things that we found is a lot of the Asia-based suppliers also have other locations, right? So we've worked with a lot of companies who have made the right call after some guidance, and they've worked with their existing suppliers and they've found other locations. Their supplier will broker relationships in other countries, or they'll set up their own satellite offices if there's enough volume there. So I think that's a much more responsible way of handling the transition, as opposed to just completely changing the supply chain right away.
It's very challenging often to change supply chains, change suppliers. There's an old saying, the devil you know is better than the devil you don't, right? And I think staying within the confines of the existing framework is usually the least friction, the most frictionless path forward.
And I think another piece of this is just a lot of the raw materials are still coming from certain countries. So unless you have enough of your production that's finalized in that other location that you might be manufacturing, you still may get tariffed on the component at the component level. So it's really important to comply.
That makes sense.
This all kind of flows into, again, a thing that MP Capital talks about a lot, and you'll hear us talking about it over and over again. It's that what I call that fourth statement that is often not overlooked. We find that typically founders and management teams are very familiar with the P&L, with the balance sheet, and even with the cap table, right? Those are three things that I think all when I talk to management team, the founders, they usually have readily available, can quickly send us. And then we ask for a cash flow statement, and often they don't have them, even fairly sizable businesses. And it kind of shocks me sometimes. Cash flow statements are really literally measuring with the oxygen of a business. That is actually what drives the day-to-day decisions. Running out of cash is the single biggest reason many of these businesses fail. I don't think any business, small or large, can afford to not be measuring cash flow and monitoring cash flow on a regular basis, and ensure they have a great, strong system to do that. We advocate typically kind of a shorter term view and a mid to longer term view. So that's typically a 13-week tool and then a 12-month tool. The 13-week is a little bit more short term. It'll tend to be more accurate because you're looking just 2-3 months out, and cash needs can change often quickly with the different parameters. The 12-month gives you a little bit longer lens, may not be quite as on point, but it'll give you an early warning radar to give enough time and enough planning to figure out longer term issues, whether you're a big debt coming due, or big cash flow crunches, or needs for much larger raises, or new products launches, or new product development, things like that can drive big cash needs. So that's a critical element of it. Prioritizing the receivables and the payment cycle, right, and optimizing those are a critical element of cash flow planning, especially when it comes to hard goods businesses. That means collecting on time just as much as it means managing payments. Obviously, you don't necessarily want to fray relationships with your vendors by paying late, but there's no reason not to optimize when you pay, and also pull in and collect as fast as you can, because the shorter you can create, shorter delta you can create between receivables and payables, the better your cash flow management and the better your cash runway will look like. The other big thing we advocate at NP Capital is active communication with your vendors, with your supply chain, and other members of the team that are involved in the cash flow cycle. And then we also, of course, ultimately focus on getting, advising management teams that once they can buy enough runway to like get through the issues that they need to deal with, they really want to focus on a long-term strategic solution if they're going to have big cash issues that are looming, on the horizon.
Mm. And then what do you recommend they do after they've evaluated their cash flow and might feel a bit overwhelming? What would they do at that point?
I mean, we're here to be helpful, obviously, but helpful too at NP Capital. I think again, I go back to, I think, the starting point can be whether it's through your CFO, or many firms have accounting for firms. Obviously, someone like NP Capital could be helpful in the right moments. But the important thing is the management teams are focused on the fact that cash flow tools are a really, really important part of strategic business planning and need to be monitored and need to be measured and need to be looked at regularly and updated regularly. There has to be a system in place to tracking it, to track and to build, track, and monitor it. We tend to have a very business minded mindset, obviously, with the tagline helping David best Goliath. We are here typically to help smaller, which means by definition often cash challenged businesses. So we've seen a lot of these things play out in the real world, and we have a lot of tips that we can come up with, just because we've seen a lot of different industries and a lot of different types of situations, and we've often been able to apply lessons we learn in one area to another, and can be instrumental in solving problems that way. But we tend to have a very kind of a very scrappy mindset around these things that are kind of focused on real world solutions, as opposed to what I call high level strategy and advice that often is not as relevant to small businesses or businesses in the trenches at getting things done.
Definitely. And you guys are phenomenal negotiators too, which is really helpful for businesses that are looking to have these tough conversations with suppliers, but might not want to do that themselves and have somebody to guide them through the process and be that strong advocate for them.
Thank you, Hannah. Yeah, we're trying to bring what I call the sophistication of Wall Street to Main Street, and that's where we're trying to again bridge that gap between David and Goliath. Take some of the tools and tricks that Wall Street has been using for a long time and bring them to Main Street.
Awesome. So that's really helpful. Now I'll stop sharing the screen and get into audience Q&A. Give me a second while I pull it up. Yeah, I think that was some really nuanced feedback for businesses that are struggling with tariffs today. It's a really tough environment to navigate, and so getting
the one good thing I think is that it's something that's affecting everyone, and something affects everyone, not necessarily equally, but at least it's not necessarily targeted to a specific business, or even a specific sector necessarily, although in some cases it does affect some more than others. But it's generally an issue that if you're in a certain arena or vertical, your competitor will have the same issue you have. So I think that makes it a little bit of a softer blow than something that's just more unique to your individual personal business.
That makes total sense. And so for the first question, I think I'll pass this one to Justin. If tariffs are now part of the new normal, how does that change the way CEOs think about safety stock and seasonal purchasing?
So I think we touched on this a little bit earlier, but because of the seasonality of a lot of these businesses, you're ordering in advance, which is tying up cash flow. If you anticipate the tariffs are coming, you might even purchase more in advance, right? If there's, between announcement of when the tariffs come into effect and the actual effect date, we're seeing a lot of companies pull forward their supply stock, which can crunch cash flow even more, right? Because that's more time between when they're ordering and when they're transacting typically. So I think most CEOs are looking to kind of try to hit those windows that they're given between when the tariffs are going to be enacted, and when they actually can get the stock through. So it's kind of a double-edged sword, right? You get the product in, but then you're having to manage cash flow.
Well, this is a classic area where we again separate the kind of P&L, which often business owners mistake for the cash flow. and how the two are so different, right? Because this is an exact example of where the P&L will benefit, whereas the cash flow will get worse, right? If you're going to, let's say if you order in advance or bring in things early, right, in order to miss a tariff window starting, then you're going to tie up more cash in order to do that. So your margins will be stronger at the end of the day, but your cash needs will be higher. And so that's exactly why you have to really focus on understanding exactly how much benefit you're getting for what you're doing. The last thing you want to do is pull something in, tie up a bunch of cash and then run out of money, and not even have the opportunity to take advantage of what you were trying to do in the first place.
Yeah, that definitely makes sense. So for the second question, I'll give this one to Nick. If you're a small but growing customer, how do you build leverage with suppliers who are much larger and based overseas?
Yeah, I think, look, at MP Capital, we pride ourselves on boxing above our weight class. I like to say, it's a art and a science, I would say, and it's something that you have to learn to do by being both fair and firm. There's no magic bullet or magic answer of how you gain that leverage, but it's basically involves a keen understanding of the situation, the leverage points, both your personal needs and concerns and those of your supplier, and how you can create win-win scenarios. I always advocate having discussions and relationships at the highest levels. I've always been a big advocate of that, especially for small businesses. Get to know your suppliers, not just at the business development level or the manager level, but at the ownership level if you can. Really form. There's an old saying: mind share is market share. It is in some cases, you in order to get the unfair advantage, you have to be the squeaky wheel. These are all things that I think we just learned through the years, having been in the trenches.
Yeah, that's great. Relationships are definitely the heart of everything, and having that open line of communication and having the trust built in from a long duration of communication is huge. So for the next question, I'll give it to Nick again. What are the most common cash flow blind spots you see in an import-heavy business?
Well, I think in an import-heavy business, I think again it's similar. It's usually a goods business, right? It's a physical goods business, so I call it a widget business. If you're importing something, you're typically importing some kind of product, and that means that you're typically tying up a lot of money. Now, one of the things we've seen often is that whereas if with small businesses, whereas U.S. suppliers will give them terms, often foreign suppliers will not. That's one of the biggest things I see. So, for example, if you're dealing with, I've rarely seen like smaller businesses or clients of mine get any kind of favorable terms with, like, for example, Chinese suppliers. So often they're paying, let's say, 50% of the total, order amount at the time they make the order, even, and then they're often paying the balance 50% when the boat leaves China or when it arrives here, or it's long before the product is sold, or even sometimes arrives in the customer's warehouse. So if you think about how long you're tying up that money relative to, for example, if you have a U.S. supplier where you're getting 30 or 45-day terms, then you can understand that even if sometimes that again, flows into the concept of P&L management versus cash flow management, and how important this is for smaller businesses to recognize. It's not always best to optimize for strongest margins or P&L. As a small business, especially those who have really high cost of capital, so often you want to focus on cash flow improvement. We have, in certain cases, chosen more expensive US-based suppliers because of that very reason in some of my past businesses.
I think also, just to jump in, like one of the things in the freight environment that we've seen over the past few years, the cost of shipping has gone up astronomically, right? Through COVID, it's come back down a bit. But as you're trying to hit these windows for exports and you're trying to hit the timing correctly, a lot of companies will end up air freighting things because they hadn't thought about the timing and getting that right. And that can significantly impact cash flow.
I actually think that's a great point. I see that all the time. In fact, when I had the nuts and trailers company, that used to end up happening all the time. The packaging, we needed a quick shipment to go out, or we made a packaging change last minute, and suddenly you can't wait 12, 18 weeks for the packaging to arrive. So then we end up having to air freight it. Well, that eats up all the margin, then some. You end up losing money on the order. So
And then the other extreme would be you get it in, right? You're trying to hit that window and then it sits in stock. Now you're getting charged storage fees and like a lot of these things can be unforeseen until you actually have to put them in place.
Right. It often you find that adaptability, right, and flexibility is inversely proportional to like cost, right? So you often go to these, let's say, foreign markets to save cost, right? So you can maximize your margin, but you in turn trade quick adaptability. You can't be as nimble, you can't move as fast because of all of those, long timelines.
That makes total sense. It's so important to keep those trade-offs in mind. So we have time for one more question, and it is, how can CEOs frame these hard changes internally so teams stay motivated rather than panicked?
I think it boils down to the fact that, most of these types of issues, when you talk about tariffs and things like that, they're affecting everyone. It's not just affecting you, right? It's a global problem. It's not an individual problem. I think the key is to be the smarter, nimbler, more adaptable, animal, right? Just like that's why the mammals won over the much larger reptiles, right? We often use that analogy at NP Capital because we look at that's some of the same advantages that small businesses have over larger businesses. Always look at the advantage they have is they're the T-Rex, right? They're the big, huge beast, but that also means that they don't move as fast, they can't turn around as quickly, they can't see what's behind them, right? These are all the things that small businesses have as an advantage, and you want to keep that in place. So I like to frame problems as opportunities, and I think that's how you keep the team motivated.
I love that. Be a mammal, not a T-Rex. New motto.
Mammal versus dinosaur.
Awesome. Well, thank you both so much. This has been really enlightening, and I'm sure a lot of business owners are going to be grateful to listen to this conversation. So everybody that's tuned in,
thank you for a fantastic job.
Happy to. And so everybody that's tuning in or watching later, we're going to do a round 3. So stay tuned for the next Small Business Essentials series, and I'll see you all later.
Thank you.
Thanks,
Bye.
everyone.